All right, so week number 3. So we also have got a bunch of ads this week. A bunch of people wanting to join in on the class. So for all of you, you know kind of the situation if you read the syllabus or looked at the other details that um, you really aren't behind, other than the weekly turn-in things that are just 5 points each. But even those, if you get behind, turn them in. One thing too that I'll say on grading, just before we get in there, if you see your grade and you're doing great, and you're like, you know what, that term project sounds like a hassle, I'm just going to not do that. Well, that's not a great strategy, because what will happen is at the end of the term, your score for that will be entered as a 0. And so right now, just the way Blackboard does the grade calculations, it's not part of the calculation. So I would very much discourage you from this class is not hard to get a good grade in. But if you skip an assignment because you think you got an A already, and then all of a sudden about a week out from the final, you see a 0 entered, and it's not just like an F. An F is 50%. No, a 0 is nothing. So anyway, it can be quite detrimental. So anyway, I have had some students in the past going, yeah, I decided not to do the term project, and didn't work out for them, or just took them down at least a full letter grade by not doing that. So I know it can be a hassle, but I also know that it's pretty much the most useful thing in this course. So we'll talk more about it as we go. Tax concepts. Yeah. Nobody likes taxes, obviously. Nobody realizes really what they're even paying in taxes, and especially what they're going for. I mean, I'm not going to get political here, but if you think the tax dollars are used wisely, I celebrate that. I like that positiveness. Me myself, I actually spoke to the IRS today. I've still got some tax returns from 17 and 18, and if you're not pushing things to the limit, you're not trying. So anyway, it's no big deal. They didn't pay me the money yet, so they're not. I'm not in any serious trouble, but they want a few more documents because I've got multiple businesses and multiple write-offs, and by God, I'm going to take every single one of them. And I actually had a lady she was amazing. I say in the past tense because she passed away. It's been that long, but we worked on these taxes together, and she was an accountant. She did this stuff full time, and I thought I knew a lot. Oh my God! Well, this woman, she worked for the IRS for a long time, and then she became a lawyer. She went to law school like 62 or something. So she was getting up in her years, but man, she saved a lot of people a lot of money because she challenged them in every step of the way, and perhaps maybe she challenged them a little too hard, and that's why I have this discussion with the IRS. But it'll all go well. But, I would hate to go through life, and that is a problem. Most people are too cautious with taxes, and they overpay. That would not fly in places like Europe, France especially. They have a huge value-added tax, like 20% sales tax, but they don't actually call it sales tax, and you don't actually see it because it's already included in the product. So it's very insidious. But they know full well that if they relied on people to file their annual tax returns, like I get a tax document from Germany, and it's not much money because they already got their money. They took it up front. They use this VAT, the value-added tax, and they took 20% every time a product changes hands. And so they end up getting they don't do income tax. They do a little bit in property tax, not much. Most all of it is just this kind of sales tax on steroids. So enough of that. Anyway, I'm just saying that our tax system is incredibly complex. In fact, one more aside here. There was a guy, what was his name? Anyway, he was an old Secretary of Defense, and he thought he was just a big. I was in the military, and some people they take themselves pretty seriously. And this guy, you have to sign off on your taxes every year, saying that I filled these out to the best of my ability. and in accordance with all the applicable tax laws. And this guy would always enclose a letter saying, this is beyond human capability. I cannot, in good faith, say that I actually complied with every law because it's incomprehensible. There's so many conflicting things going on. So anyway, he would, I don't know that it kept him from being audited. But anyway, it was pretty realistic because the tax code is complex by design. I mean, there's the loopholes are the tax benefits for other people. Everything that's in that tax code is there for a reason. There's some constituency that's benefiting from it. So things are not necessarily in there by mistake. And the complexity, it employs a lot of folks, a lot of lawyers, a lot of everything else, including more IRS agents. So anyway, roads, the military, they pay for a lot of things that are obviously quite worthwhile. And then you also pay a lot of taxes. Most people just think income tax, but I've alluded to sales tax, which isn't really an issue in most parts of Alaska. There's some here in the valley for the first $500, but nothing in Anchorage, except now they have some sin tax on alcohol and other things to, obviously nobody is going to come rallying to the defense of folks that they can, whatever. Nobody wants to be known as the one that says that their alcohol's getting too expensive. So it's a pretty easy kill for the politicians. Anyway, consumer purchases, wealth transfers, capital assets, and then these special taxes. Those are kind of the sin taxes, the ones that people maybe feel guilty about, or it's paying for the roads and stuff like that. But actually, it probably just ends up in the general fund and off it goes to a bunch of whatever. I mean, I don't have to talk about how your taxes are spent, especially if you live in Anchorage and you've tried to deal with snow and you realize that snow plows seem like a worthwhile use of taxes, except for the people who have control of that money. Background on taxes: corporations pay taxes on profits. So corporations, big evil corporations, but guess what? Corporations are owned by shareholders. And so the deal with corporations is they pay a tax as a corporation because they're an entity. They have personhood status. That's a great advantage of being incorporated, is that it's a perpetual thing. It's not tied to a certain one person. But the problem when it comes to taxes is that entity, that tax is, there's a corporate income tax on that entity, and then the actual entities, the shareholders, the people who own those shares, they get taxed again. So double taxation is something. If you hear about that, that's what they're talking about. Corporations paying corporate tax, and then the shareholders getting that profit and being taxed on it once again. Homeowners pay property taxes. Yes, they do. Again, very MOA centric. It's quite a bit higher in the Anchorage borough. They are tax deductible though on your federal taxes, which is good. We'll talk about tax deductible. We'll talk about tax credits also tonight. Taxes are used to pay for government services and programs, and you pay them generally at all levels. And even in Alaska, I mean, we do better because of the PFD, the permanent fund, but we still, if you're the fees you're paying to DMV, the fees you're paying on your property tax, they're still getting some tax out of you. And oh, by the way, if you tax a corporation, well, corporations, they don't have an endless source of funds. They sell stuff. Well, they sell stuff at a bit higher price if they're getting taxed at a higher price. So you're paying their tax. It's just passed right through to you. So it all happens. Federal income tax, the IRS. Quite familiar with them. Taxes are paid several ways. Yep, time of transaction, withholding, and estimated quarterly payments. So what happens is when you're paying your taxes when you look at your paycheck and you see a deduction, that's just sort of an estimate. And so when they talk about making estimated quarterly payments, that's generally for in this specific case, that's generally for businesses that don't have a withholding because they're self-employed or something like that. If you happen to be somebody who owes the IRS money every year, they may ask you to start making estimated payments because of your situation. They don't like to be when your money is withheld out of your paycheck, it accrues into an account, and if that account in a perfect world matches the amount of taxes owed by you, that is what they're looking for. If it's way short, now they're kind of pissy because you in essence in their mind got a free loan. Now they're more than happy for you to overpay your taxes, to over withheld, and get this big refund at the end of the year. And people who don't know taxes, they think they're getting one over on the government and everything else because they got a big refund. No, you overpaid your taxes throughout the course of the year. You gave them a big free loan, and don't expect the IRS to squabble about that because they like people who don't understand time value money. They like to be overpaid, and they'll give you that residual amount at the end of the thing. It's not a mark that you're doing great by getting a big refund. It's a mark that you've overpaid. So keep that in mind. And then tax. Yeah, we had all the weirdness with COVID, but taxes are always paid in arrears, which means the previous year. So we're in 2023 right now. When you go to pay your, you go to TurboTax or something else to pay your 2023 tax, no, you're going to be paying your 2022 taxes. And that tax year closed out, the end of last year, so you can't make any changes at this point. You're not going to typically file your taxes till April 15th, but things are, for the most part, frozen. There's sometimes some IRA deductions you can change, but for the most part, any changes you were going to make had to be done within that previous tax year. So I'll, give you a pretty useful strategy to look at what your taxes are going to be before the end of the year, so that if you need to make any changes, you can make changes and have them applicable. So there may be something about, I'm going to sell my house, and there's a few days either way, or I may be selling some stock or some asset, and it's going to generate a taxable capital gain, meaning I've made some money, or I'm going to take a loss. It's useful to know that in that tax year so that you can make changes. If you wait till after the 31st, you can do whatever you want with that property or stock or whatever, but it's going to apply to the following year. That'll apply to the 2023 taxes, which won't be done till 2024. So, Social Security, Medicare taxes. Yep. There's big deals going on. I mean, again, the French are a great example where there's massive riots. Our news is not good. Anyway, they're not talking about any of that. But yeah, there's huge strikes going on in France right now because they're trying to push the retirement age from, I believe it's 65 to 67. We're already there. The Social Security kind of moved that date to 67, the age where you get the the recommended retirement age. You can actually start drawing at 62, which I'll do. As soon as I turn 62, man, I'm taking whatever money I can because the system is insolvent. Or you can wait till like age 70 something and perhaps get a little bit more. But anyway, the retirement age for Social Security and for those benefits and the recommended retirement age in the United States is 67. And a lot of governments are in bad shape, and in fact in Russia, and this was well before the situation in Ukraine, they had pushed out the retirement age beyond the average life expectancy of a Russian. You know, Russians, due to health issues and a lot of alcohol and other issues, the average Russian doesn't actually make it to retirement age. So it's a great deal for the government because they'll promise to pay a pension that, in many cases, they'll never ever pay. Other taxes you're paying: FICA, so federal insurance, Social Security, Medicare. So a couple different programs out there. There's Medicare, which is the one for people that are, of that age, 65, and it, supplements their medical payments. There's also Medicaid. Medicaid is like a welfare type program. That's for younger folks, but it's, a different system. Probably not as elaborate, but it covers children and other things. Yep. Employer matches amount. These dates are old, but anyway. And then if you're self-employed, you need to actually withhold and pay these amounts as well. So there's all these forms out there: 1040A, 1040EZ, and filing deadlines April 15th, like we said. If you're max performing, getting the most benefit out of the tax system, you can, because again, you want to, we're kind of like rats chasing government cheese. They're trying to manipulate behavior, and sometimes it's good. There's if you adopt a child, a lot of those legal fees and other fees are paid, or essentially paid. You get a tax credit for them, meaning it's taken off your taxes because they want to encourage that kind of behavior. Home ownership. There's all sorts of perks, for having a home mortgage. That interest is tax deductible. The different aspects of home ownership are incentivized because home ownership makes society a bit more stable. And there's, electric vehicle credits and other things that they're trying to get people to do. And that's where those things exist. Well, those are available if you're filing a 1040 and you're itemizing your deductions. The government also says that, hey, rather than, list all these separate expenses, we'll give you a standard deduction. And let's say that standard deduction is, I don't know, maybe $20,000. And it's like, unless you have a whole bunch of little deductions that end up at $20,000, why don't you just take our standard deduction and we'll call it good and save a lot of paperwork and a lot of calculations. But if you're really doing well, you have some rental property, you're deducting the depreciation on that home, you're deducting a bunch of other items, your own home, you're probably going to exceed that standard deduction, the one the government affords you, and you're going to itemize, and you're going to take all your little individual type things. It's kind of complex, but we'll talk more about it as we go. Okay, federal revenue. So this shows, it's even blurry on my slide right here, but you can interpolate that income tax is only about 50% of the total tax bite. The other parts are, excise taxes, which are some of those different taxes that are played on specialty items, payroll taxes, the Social Security and other stuff, corporate tax, kind of a small bite, but largely passed back on to you, and then other taxes. Highest earning 20%, pay 88%. That is a true number. So there's different tax systems you could have. There's a progressive and a regressive. And so you've seen in a lot of ways again, it has to do with donors and other political considerations, but the tax code, I would argue, is getting to be more regressive, meaning, let's say, you tax everybody $100 for something. For the person who makes $1 million a year, $100 is nothing. For the person who's, making $10,000 a year, $100 is a substantial amount. So that would be a regressive tax. Now, if it's a percentage of your income, that's probably getting closer to a progressive tax, but it's not quite there. The way our tax system is set up is there's tax brackets, and as you make more money, you're taxed at a higher rate. So not only does the person pay a lot more in absolute dollars, but they also pay at a higher rate. And, that's deemed fair. And I mean, I have no argument with it. It's, the wealthier can afford to pay more. And so we'll talk about tax brackets because a lot of people don't understand tax brackets. And there's a good video that will be part of your thing, and you'll see that and you'll understand it forever. Here we go. Rise and fall minimum wage. Yeah, minimum wage, if it was realistic, it would be hugely, the deal is that wages have not kept up, not at all, with inflation, not even close. It used to be where, one family, you'd have a single breadwinner, in the old Ozzie and Harriet thing where the dad goes off to work, or it could be the mother as well. But anyway, the standard thing in the States in the 50s maybe, in this dream world. And like even in Spain, when I was over there, I mean, there was always maid quarters in all of the homes. It's like nobody can afford a maid there anymore. But anyway, and then it went to be, okay, well, both parents need to work now. And then they were kind of getting by, and people were maybe semi-happy. Now it's both parents are working, and they're, still not making it, and they're going into debt. So it's gotten a bit worse in terms of disposable income and wealth. But anyway, not to be too negative. Filing status. So the IRS is going to charge at different rates. There's going to be different thresholds based upon your filing status. So if you're just an individual, if you're just single, that's going to be the highest rate. A single guy making person making $100,000 is going to be taxed at a higher rate than a married couple making $100,000. I mean, that only makes sense because they're making more money. Whatever, it's just the way it's done. There's two people being supplied with that $100,000, having to live off that $100,000, whereas a single person, there's just one. Now, there's also cases where there can be a disparity in income or different tax situations where it may be advantageous for these married people to file individual returns. And that, again, is where something like one of the TurboTax or one of the other automated programs kind of takes over. I'm not shilling for TurboTax. I mean, we're seeing, some of the big companies, all these companies kind of have a shelf life. It seems like they hit a peak and then their service just gets worse and worse. And I don't know where TurboTax is on the continuum, but, you look at some of these things like Google or Amazon, their best days are behind them. Obviously they're trying to buy up the competition now, but they're a bit vulnerable because they're if you've ordered anything on Amazon, it's taking like a month now, whereas I don't think that's just anecdotal. I think it represents the fact that they're financially in the same place, not in the same place they were. And you can see all the big tech companies not hiring, but laying off all the people this week. So maybe something new will come up. Well, the same may be true of TurboTax and the whole Intuit empire, but right now they're kind of the dominant one out there. And I'm not advocating giving these people any money. In fact, I don't. I just run my taxes on their program just to double check the individual calculations that either I do myself or people who work with me do. So it's kind of useful. I'll show you how to do that. Okay, head of household. So let's say you've got some dependents, maybe some children, maybe some older parents, something like that. You've got multiple people in the household, and so it's probably not fair that it's you're just treated, and when I say fair, this is as determined by other folks. But anyway, it's been deemed that the head of household with dependents should get the benefits of somebody married because they've got people dependent upon them. They've got dependents in terms of the tax system. So, and then qualifying widower, widow, whatever, just because it's a fairly traumatic situation. So for a certain length of time, they'll be able to file in their own status as they adjust. So, 1040. What's going to happen here is all of your income, is going to go down in a certain section. Everything coming in, and then that's going to give you this AGI number, adjusted gross income, and then you're going to start to deduct things out, and then it's going to tell you what your actual, what the AGI is, and then you would enter the tax tables with that. This is all pretty time consuming, and tell you the truth, if you're using a computer program, it's actually taken care of for you. You don't actually see these forms, and they ask you the questions with, it's just a little more user friendly, a little bit more just easier to do. Anyway, so if you did that, it would tell you what your taxes are, exemptions. So again, the children or whatever that can claim you, alternative minimum tax, which was something put in there to try and capture people who aren't paying enough taxes, but it doesn't really do its purpose anymore. Child tax credits, some things. Now these are things that are going to reduce your taxes. Some self-employment stuff, healthcare, other things. And so you're going to come up with a number, and then it's going to look at how much has been withheld. So how much were paid in really, literally estimated sort of payments. And those two numbers are subtracted from one another, and the difference is what you owe. So no big deal. And you may get a refund, or you may owe some money. If you owe them a bunch of money, like I say, things are going to get not difficult, but they don't want it to happen again. They are not anxious to give you a free loan. Again, they will not complain if your refund is excessive. Nobody's going to say, we probably owe you some money on interest. So gross income, that's the maximum number. All kinds of things coming in. And it can be, gambling winnings. It can be all kinds of stuff. Interest income, obviously the wages. So it's more than just your wages. It's more than just on the W-2. Dividends, if you're doing, have stocks or whatever that are paying that, or accounts that are paying that. Capital gains, that has to do with, exactly what it says, when you sell an asset at a higher price. And that same model that I was talking about before, pardon me, if it's been longer than a year, it's going to be long term. Shorter than a year is short term. And the tax rate is huge. It changes drastically. So, whatever, if you're in a 28% tax bracket or something like that, your tax rate is going to be at that higher rate. If it's a on the long term, it's going to be at around 15%. The way they've got this worded is kind of different. But anyway, on short terms, like if you're some day trader, you're going to get hit at your normal tax rate on ordinary income, as if it was wages or something like that. Determine gross income. Yep. Different forms for each one. All these forms, if you're, using a service or using a computer program, there's ways to get at the actual forms, but you generally don't see them. It's a bit more transparent than that. Capital gains and losses. Keep in mind, that for a lot of these things, the IRS is gets a statement as well. When you get a form in the mail, the IRS has probably got that same form as well, and so if you don't claim the right numbers, it's not going to go well for you. Okay, so determining gross income, adding all those things together, and then the AGI, adjusted gross income, other things, payments, interest paid on student loans if they qualify, and other things. The numbers in here may change based upon the rules. So again, that's a good thing about running one of these programs, because you may be under the impression that, oh, all that interest on my student loans or other things are going to be tax deductible. A lot of times they're not. Standard deduction, yeah. Oh, there's alimony. Alimony is not that common. What do you call it? Child support is not tax deductible, but they don't do alimony so much anymore, because the problem with alimony is it comes to the recipient as a payment that's taxable, whereas child support can be whatever, and it goes to the same parent, and it's tax-free. So you'll see most of the judges work the child support angle because it ends up with more money to that person. Standard deduction. So this is what I was talking about, where the government picks some arbitrary number and says, this is what we're going to allow for a single person. It's just going to be some random number. And unless your deductions are more than that, don't bother. Just take the standard deduction and use the easier form. So yeah, they change it each year to keep pace with inflation. So these again, old numbers, but different numbers depending on the filing status. But standard deduction now, I believe, is about 18,000, 21,000 even. So itemized deductions, specific expenses. So, I mean, this gets crazy. This is all the collecting of receipts and other things. And, let's say you're, a military guy and you got to get a haircut, whatever, every month as a condition of your employment. Or let's say there's books or something you have to buy for your job that are not reimbursed by your employer. Or you're a school teacher and you're buying extra supplies that are not provided, you're not being reimbursed for. All these things can be deductions. So, interest income, that's for real estate. And, yep. State income tax. This is kind of a big blue versus red state thing. A lot of the big blue states, California, New Jersey, New York, whatever, would have huge state income tax. And the person who actually paid for it were all the other states, because these people from the blue states would pay, exorbitant amount of local taxes, and then they would deduct that from their federal taxes, which meant that the federal government got less money and therefore would raise the tax rates in general. So there was some switching back and forth. Under Trump, they put a cap on that, and then obviously under Biden that went away. So you'll see that change, but they refer to those in general as SALT, state and local taxes. So if you were living in California, for example, you would probably be itemizing just because your state taxes would be pretty damn high and put you above that standardized deduction amount. So real estate taxes, deductible, medical expenses. I mean, it's good news, bad news. The good news is that they're tax deductible. The bad news is that you're pretty sick. If you're making $100,000 and you have that would mean you'd have to have over $10,000 in unreimbursed. If insurance paid you for it, that's not your expense. So these are out-of-pocket expenses, not reimbursed. Over $10,000, so you're pretty ill. Charitable gifts, though, that's all good. And again, these are things that, are considered good. They have clamped down on that a bit, though. Some people were, selling used cars as a hassle, so they donate their car and inflate the value, and the IRS is not going for that anymore. They've changed the rules because people were, donating garbage cars and claiming a big reward or a big gift credit, and the IRS now wants to follow it through to see what that vehicle actually was sold for on the donation. And if you wonder why all those donate your car type things kind of went away, it's because the crappy cars were not going for that much money, and so it didn't make as much sense. Other expenses, yep, I've done this before where, let's say you have a car with just collision on it, or you don't have collision, meaning if you get in a car wreck, you're responsible for the damages to your own car. You're not going to get any money from insurance, but you can write it off as a loss. And then the job expenses, which I kind of referred to before. Things that are unique, and again, it gets very complex in the rules. You got to read them, you got to figure it out, but there's ways to get around that. Not ways to get around. I'm just saying there's ways to get around the difficulty of the IRS publications. There's other methods to get an understanding and then just verify it with a code. So what you're trying to figure out is whether to itemize or use the standard deduction. So I haven't taken the standard deduction in 20, 30 years. If you own real estate, you're going to be, the standard deduction is not going to be enough. I mean, I think the MOA alone, I've got a house in Eagle River and then a place out here, and I think my Eagle River home, I think it's 10 or 12,000 in property tax. So it's easy to exceed that deduction. Yep, just showing the form again. So TurboTax, we'll look at that in a bit. Exemptions. So these are for the people that are living with you. Now, again, there's a lot of divorce, a lot of divorces with children. Only one parent can claim. Now, if you have two children, one parent can claim one child, or however the courts. I mean, obviously the courts they do some horrendous things, but yeah, so they'll end up with some awkward family situations. But anyway, for any particular child, only one parent can claim them as a dependent. Taxable income is that more refined number. It's gone down from the gross income, and AGI was used, and then they took out the deductions and exemptions, and then you theoretically would go into the little chart and it would tell you owe this much tax. Again, for most people, the program tells you how much tax is to be paid. This was 2021, but this gets into this notion of tax brackets. I'll run through it really quick. There'll be, again, another explanation video, but you'll hear people, you can really tell a lot, or how little people know about taxes, the way they refer to tax brackets. People will say things like, well, I don't want to make any more money because that's going to push me into a different tax bracket. If that person says that, just whatever, be polite, but realize that person doesn't have a clue, and they should not be doing your taxes or giving you any advice because they don't understand the situation. Now, it is true that if your income gets to a certain threshold, you might not be eligible for certain programs, like the Affordable Care Act, the Obamacare stuff, or other things. You'll see people say they don't want to work in a certain profession or want to cut back on their hours so that they still qualify for one of those government programs. That might be valid. It's not a good thing, but it's the government incentivizing people being less productive, but it is what it is. But anyway, so this is how tax brackets work. So let's say somebody's doing pretty well. By pretty well, not super well. Let's say they're making right at $100,000. Okay, so what's going to happen to that person's income? And I'll go down to the single individual just because it's easy. Okay, so person makes $100,000. The first little tranche of income from $0 up to 9,000, basically $10,000, nearly $10,000. They're paying 10% tax on that income. Okay, that amount of money that they make from 9,951 up to 40,000, 40 and a half, is taxed at 12%. That person next income is taxed from the income from 4526 up to 86 is taxed at 22%. And then for their final bracket, their income from 86,376 up to, in this case, 100,000 because they're only making 100,000, is taxed at 24%. So let's say some person, using, kind of the idiots example, let's say somebody says, well, I'm making 86,375 and I don't want to get paid any more money because if I do, it's going to push me into this other bracket. What they fundamentally don't understand is, let's say you're making $86,376. All of your income is going to be taxed at these respective rates for those different tranches. But that $1 that exceeded, 375, 86,375 is going to be taxed at 24%. Not the rest of the income, just that dollar that exceeded that amount. So, your first chunk of income's taxed at this rate. Up to 40,000 is taxed at 12%. That next bit of income from 4526 up to 86 is taxed at 20. They're brackets. There's not some sort of retroactive thing where, your whole 100,000 is taxed at 24%. No, the only part that's taxed at 24% is everything above 376, 86,376, up to this higher limit that you didn't achieve. So that's what brackets are. So and this is where this sort of progressive tax, this is where the progressive tax comes through. The more money you make, the more money, the absolute number is going to be quite a bit higher just because the numbers are higher, but the rate is also higher. So that's how it works. Now keep in mind, these are federal taxes. So, the states can do their own thing. In fact, some of the states like New York and stuff, they've upped the rates on people making, a millionaire tax or whatever. Well, guess what happens? They don't have any more millionaires. The great thing about being a millionaire is you can move, you can hire a lawyer, you can do whatever you need to do. You ain't going to pay that tax. You can skip away from it. You go to the Caymans, you'll recharacterize stuff. It's whatever. It doesn't work. There's a guy he's not controversial, but some people think he is. His name is Art Laffer, and he's a Reagan era kind of guy. And his big concept, he's still around. You'll see him on the news now and again. But he had a thing called the Laffer curve, and what that meant was there's a sweet spot where, let's say maybe it's 24% or something like that. If you tax people at that rate, the government is going to get the maximum amount of money. If they tax 37%, the government's take is actually going to go down. If you tax at 10%, accordingly, the government's income is also going to go down because the percentage is less. So there's a sweet spot in here where, because what happens if you tax at a higher rate, people are like, they work harder trying not to pay their taxes, or maybe they just go, I'm not going to make over 500,000 because they're going to charge me, they want some whatever tax of 80% for every dime made over 523,600. Guess what? I'm not going to work that hard because this threshold is too high. And this, again, these numbers reflect, these were the Trump numbers, so they're not necessarily as excessive. If they were redone now, they might be higher numbers. But anyway, what happens is, if you think about it in terms of like a pizza, right? If the economy is small, you're looking at a small pizza, and so let's say you take a 20% slice of that small pizza. It's not a lot of pizza. Now, let's say instead of taking 20%, let's say you take 15%, but because the tax rates are better, there's a lot of things that influence investment, and the tax rates are whatever, judged to be more fortuitous, and people invest more, and the economy grows, and the economy's thriving, you end up with, perhaps a large pizza. And so, although the government's only taking, 10 or 15%, the slices are much bigger because the economy's thriving. And so, it's a concept that's not really understood very well, and that a lot of the politicians who are in favor of so-called millionaires taxes and stuff, they probably understand the math, but they realize their constituents don't. So it's a good popular issue, and they'll never follow through with it. They'll do what the donors say to do, but they'll come out in campaign saying that they're going to tax the rich, and if you look at the rich, they're nope, not happening. Alrighty, long-term capital gains. So, what can happen here? Yeah, so these are just the different rates, long-term. So, less taxes. If it was a short-term capital gain, it would be paid at whatever that amount was. So, let's say back on this example, you made $86,376, and then you've got $1,000, from some stock sale. Well, now that stock sale is going to be added in here and charged at the 24%. It's going to be charged as if it was just wages. Whereas if you kept it over a year, you're looking at long term, and it would have been taxed at one of these lower rates. I mean, 20%, but bam, you made 500,000, 445,000, whatever. You can deal with that. Determine your tax liability. So we talked about how to do that. Go into the chart, figure out what it is. Tax credits. So credits and deductions. Deductions are good. Credits are amazing. So a credit means that, let's say you go into the chart and you would have owed, let's say 20 grand in federal income tax. If you've got $1,000 credit, well, that's going to come, it's a one-to-one thing. It's going to come off $1,000. So you would owe $19,000 if you had that $1,000 credit. So credits are, used for, fairly special things. They're much more valuable to you. Now, if somebody says, "Oh, buy this ticket or give to this raffle or do whatever because it's tax deductible, because it's a qualifying charity," what that means is it doesn't mean a one-to-one. It means your income comes down by that much. So, again, rolling back to the same chart, let's say you're making, $86,375, and you have $1,000. You give money to somebody, and it's a $1,000 tax deduction. It just means that your income would be taxed at 86,375, right? Or 85,375, $1,000 less. But the actual money in your pocket means that you saved just 22% of that, so $220. I'll go through this a little bit more later. Let's, well, I'll show you on the TurboTax. It'll make more sense, but in essence, tax deduction just means that percentage is coming off. You're still going to have to pay the other amount. So the short answer is tax credits are way better, but they're not for everything. Yeah, try doing that if your income exceeds a certain level, which is not very high. I thought I was going to be getting a break on that and found out I didn't qualify. Coverdale savings accounts, 529 savings accounts, IRAs, 401ks, things like that. We'll talk about that, but I'll say one thing right now. For example, let's say you're doing your term paper and you want to get an A on it, and so you talk about your plan for life, and you plan at some point in the future, having children in your relationship, whatever that is, and so there's children, and you're going to save for their college because it's a good thing to do. So you put some money in some regular mutual fund, and the kid ends up with $100,000 in that account for their college savings, and you turn it in and you get a B on your paper because you screwed up. There are specific accounts that you could have used, and one of them is a 529, where you could have said, I'm going to save money for my child's college education, and I'm going to put it in a special 529 account and designate it as such from the get-go, from the start. And so when that child gets to be that age, that child can pull that money out of that account, and it's not subject to any taxes because it was used for education, and you designated it as such. The other person in the original paper who just got the B, say they gave their they had $100,000 in their account, and they're going to cash that out and give that money to their student. Well, they're going to get taxed on it because it's just normal income, and so your kid's going to get, I don't know, maybe $85,000, something like that, 15% capital gains tax. So you could have done the right thing and studied up on it a little bit and realized that, again, in the tax code there are certain things they want you to do, and saving for college is one of them. And so they have programs out there that will encourage that. Earned income tax credit, doesn't apply for most of us. And anyway, I think most of you are going to be beyond that limit here pretty quick. Like I said, child care, adoptions, all that stuff, taking care of your kids, adopting other kids, that's all viewed as a good thing. Another TurboTax type thing. We'll go there in a second. And then homework. So problems 5 and 9. Okay, so the TurboTax program probably timed out on me, but we'll see. They're kind of annoying. So I created an account for whatever, just for general purposes, and it's all fictitious information. So you can do this as well. It's not a big deal. If I can get this thing to send me the code. I might have to pause the video while I get this thing working. Alright, so back at it. So TurboTax, because they have all your financial information, it's obviously going to have at least, two-party identification or two-factor. Anyway, but you can see, my name is not just Jay, but, the silly computer doesn't know. You could program whatever numbers in here, so that's not actually my last name. No, that's not correct either. But it will work for the purposes that we're trying to do. So anyway, the good news about all this information is if you put it in year to year and you're, one of their customers, all this stuff is sort of pre-populated, which makes things a bit more efficient because, you spend your time actually doing your taxes rather than entering all your, employer's information. For this example, I'm just going to use single. I'm going to say no kids. I just put in a bogus address, right zip code, so it knows I'm in Alaska. Make money, so typical, no extra money. And single, I don't care. I'm just want to show some examples of what can be done here. What I'm going to do is I'm going to put in, and they're going to try and upsell you. Now, the reason why I use TurboTax for this example is none of these programs charge you until you actually file. So you can go run through these, do all your examples and everything like that, and not worry about having to pay any expenses. I'm going to say, I'm going to put some numbers in here, but obviously not mine. And invalid Social Security. Maybe they've got more elaborate since last year because I use this all the time. I'll put in a few fake numbers. 5 and 4. Yep. There we go. Just didn't want all the same numbers. Now it can also, these things can import data. So it's all intermingled. And nope, I'm just going to type it in myself. And so bogus numbers again, bogus employer ID, the whole thing. They're not, that smart. I'm just trying to run this for an example. Whatever. It can have an address. Okay, so the wages. To keep things simple, I'm going to put in $100,000, right? Social Security wages, typically different, but I'll just put in the same 100,000, keep it simple. I'm going to say they kept out 20 grand. I'm not doing such a good job of doing the withholding, Social Security. Yeah, I don't know. What was it supposed to be? I'll go with 6,800. That seems about right. Wrong numbers. Just put up in the thousands. What I want to see is I want to see how much it says I owe in tips. Or not tips, but taxes. State taxes, all that stuff would be entered in down below. And it would come through and do all your state taxes. But my point is, number one, you're not seeing a whole bunch of forms. It's all pretty transparent. You can go back and do the forms, but if you start with the forms, sometimes it's going to be frustrating. You're going to be spending a lot of time. And I kind of like this method just for checking things out. Says I paid too much. Amount recalculated. Remember, good thing about Social Security tax is if you exceed the amount, like let's say you've got, and it doesn't actually catch side hustles. It will here in the when you're doing the program, but the government will only typically hold $6,200 per year per taxpayer for Social Security. So let's say you're making, you've got a day job, and back when I was teaching full time, I exceeded these amounts, and I had to literally get in there and I waited till the tax season, and I got a bit of a refund because neither employer, I didn't make a big deal out of it, and they didn't know that I had both things going on. So anyway, they're going to give that money back because I overpaid on Social Security. Whole bunch of questions that may or may not apply. I'm not going to go through it in detail too much. Continuing on. I'm not going to show any other income right now. Did I sell anything? So you would start entering some of that data off of these forms, these 1099Bs or DIVs or whatever you got. For today's purposes, nope. 1099Ks, nope. 1099s are a big thing. 1099s are for basically gig kind of income, but they'll come for other things. 1099Gs, like for example, let's say you win a bunch of gambling money, that would be a 1099G. Foreign bank accounts, they're trying to track that down. Keep less than 10,000 and you'll stay out of trouble if you're that fortunate. Okay, so now it's kind of happy with the income. And it should say, okay, so paying $20,000, having $20,000 withheld, I had too much money withheld. Now, it's all just notional numbers here, but that's what it's going to work on. I just want a number out here so that I can go through and do some of these deductions so I can explain some of the things. Again, they're trying to upsell. Good on them. I don't need any of your stuff. I mean, maybe you do. Maybe you want to get involved with these people. And it's probably better than going to, I've had some knucklehead friends who have worked for Jackson Hewitt or H&R Block where they hire these people and they come in for a weekend course and they learn everything about taxes, and you can't learn enough. If you've got a relationship if you've got complex taxes, it may be worth hiring somebody to actually do them, but not, This is kind of an intermediate thing. I would hope that these people are maybe full-time tax people, but that might be a stretch. But, I don't know whether like Liberty Tax for the guy, spinning the little arrow, goes in and fills out some returns later in the day. That's what I'd want to do. I wouldn't want to stand out there in the cold. Foreign bank accounts, I'm saying no. So it gets kind of upset if you don't ask it. Nope, I don't have any foreign trusts. We're going to skip through this, and we're going to go to deductions and credits. Okay? Again, I don't need too much help here. Okay, it's auto-populating from last year's example, right? So it knows I have a home, so I'm probably going to be deducting mortgage interest, and it knows I'm going to give some money, and in this case I'm saying it's just goodwill. These are all self-entered items. Interest paid, GG. Obviously there's not a bank called GG. Goodwill actually is out there. I didn't make any estimated time of payments. Medical expenses. Again, medical expenses, as you know, they would have to exceed 10% of your income, so unreimbursed ones. Kind of sad. Health savings accounts, we're not going there. Homeowner credit, nope, I didn't do that. And it's going through, and if you looked at the forms and some of the programs out there, these would be on there as well. But this is just a little bit more efficient, maybe. If you're going to do something with your taxes and you're confused on it, there are tax guides that are put out, and they're pretty useful. They're written kind of in layman's terms, and then they'll reference back to the original IRS publication. And then you look at the IRS publication that may or may not be overwhelming. But if the IRS publication is kind of too much, too confusing, there's plenty of companies out there that have tax guides that do that. Money on school expenses. So it's looking for deductions. And no, I didn't do that. I should have done this stuff, but in this example, no, I did not. Individual retirement account, or Roth account. Foreign taxes, nope, not doing that. Taxes on a motorcycle. So it's going to go through and catch a lot of these things. And so it's just a good reminder. So what's happened here is this is the amount of tax money. It's green number. That's the amount of money I'm getting back. Okay, so let's look at a real world kind of example. Let's say I'm somebody who's maybe renting a condo and I'm thinking about buying a house. And in addition to the rent versus mortgage amount decision, I'm trying to figure out what's the better thing to do. Now there's a lot of things lifestyle wise that may change between a condo and a house. But from a financial perspective, if I buy a home, the mortgage interest, so part of that payment, because when you pay, say, $2,000 on a home mortgage, a big chunk of that, especially on the new purchase, is going to be interest, and the interest is tax deductible. We'll go through all this in a later thing, but anyway, just take my advice on just take it as fact, basically, that on the first few years of say a 30-year mortgage, 80 to 90% of your payment is interest. And then towards the very end of the loan, a very small amount is interest, and most of it's principal. The payment never changes. If it's a 30-year fixed, the payment is exactly the same, but the ratio between interest and principal being paid is vastly different. And it's not great to pay a ton of interest, but it is all tax deductible. Your payment's not going to change, but that's why it's kind of as a house, as it's nearly paid off, it doesn't have the same tax benefit. Okay, and then also for real estate taxes, those are tax deductible. So if the numbers are exactly equal, because of the tax benefits, you're probably better off taking buying the home. And also the quality of life. I mean, there's a lot of other aspects that go into it. Okay, so let's say their interest paid, you'll get a form if you're a homeowner. If you got a mortgage, you'll get a 1098, right? And that 1098 will tell you how much interest you paid. So I'm going to look at my 1098 that I got from this mythical GG Bank, and I'm going to enter in a number. And where is it? Yeah, it's got all these things. It'll auto-populate and loan it in there, but no, I don't want any of that. And I'm just going to, well, it definitely wants to auto-populate, and I'm not going to let it go. Yep. Fair enough. Type it in myself. And does somebody else loan? The seller financing didn't receive a 1098. Anyway, special cases. Mortgage interest. Let's say I paid $18,000 in mortgage interest. So let's say I'm paying about $2,000 a month, and that's $24,000 worth of house payments. And in this case, I'm saying $18,000 of that was interest, which is, not crazy. And let's also say I live in the MOA, municipality of Anchorage. So I'm paying $9,000 in property tax. And let's go ahead and take credit for that. Whoops, outstanding mortgage principal. This isn't going to change things, but I'll say it's $285,000. Not huge. See what just happened on that number? I just got that deduction, which was translated into increase on my refund. Now, it was a tax deduction. It was not a tax credit. That's why it was whatever it calculated my tax rate as, probably around 24%. It took 24% of that $8,000, $18,000, and that $9,000, and anyway, I got more money back. So you'll have to look at your actual example, but that is the benefit of home ownership from a financial perspective, that those numbers were deductible. Okay, so now we'll go through another example. I'm kind of done with this. I just want to get into regular deductions. And it's not going to let me, is it? It's going to want to ask a bunch more questions just to refine things, and it's all good. If you only have, select yes. Details about the loan. HELOC is a homeowner equity. Oh, it says it right there. Okay, congratulations, I got that tax break. It's already reflected in there, so I know that. Okay, one other thing I'm going to look at is charity. Okay, so it's already pre-populated because I said I gave to Goodwill last year. I'm going to give to Goodwill this year. And let's see what tax bracket I'm in. So I am going to, so right now, look at this number 8317, and I'm pretty good, whatever. I'm going to give a $1,000 worth of furniture or something like that. Again, I'm not expecting to get audited, but you should maybe have some pictures, maybe a receipt from the thrift store, maybe something if you're saying it's genuinely $1,000. And they have things to estimate for you, or companies that will keep track of it for you. But nope, I'm going to John Wayne it here. I'm data deduction. So 10/22, 2022. The operable thing is that it needs to be in the applicable tax year, which 2022. So if I put 2021 or 2023, that tax year is not being addressed. These are the 2022 taxes. So that's the reason they're asking for that. What was it? I'm saying it was household items. Sure. Description, maybe something to jog your memory when you get audited and you're drugged before the people. Furniture, actually spelt it right. I'm going to claim it's $1,000. Method used, I'm going to say that's comparative sales, something like that. Consignment store, a lot of different options. Thrift store value, because it is kind of a thrift store. Okay, done with the deduction. See what just happened. So I went from 83.17, so I got, what was that, a little over $200 back. So why did I not get a whole $1,000? Because it's not a tax credit. It was only tax deductible. And so the only portion I got from that was whatever that my tax rate was. Probably, something in the 20%, which would equate to that. So I think that makes it a little clearer. But you can go through and, again, as I've shown you, you can put in BS numbers. Now again, this is sort of like your term project where you can, these websites, you can enter in kind of bogus information. They don't really care, and nothing has been filed. Nothing gets done with the IRS until I hit file, and then that's only after I pay them the money. So I could go back and change all these numbers back and forth, and I could go back to my info and go, I'm going to get married next year. I wonder what that's going to change. And so I'm going to change different things. I'm going to change my filing status. I'm going to claim single. I want to run it that way. Or I'm going to, I've got a new job and I'm going to be making more money. I wonder how that's going to affect my taxes. Or in my case, I think I've got a tax deduction because I'm paying, horrendous tuition to an out-of-state university. And then I find out late in the game that, oh, by the way, that's not tax deductible because you exceeded the income level. I would have known that had I run TurboTax, as a trial run. So anyway, there's other companies out there besides TurboTax, but these guys are kind of like the Google. They've got their fingers in everything. Credit Karma, Mint, everything we've talked about. They kind of own a chunk of it, which is good and bad. They're super easy in terms of importing documents. They can even import, W-2s. You can maybe sit down and actually make some progress, and then spend your time doing taxes by trying to figure out how to minimize your taxes in future years. There's two different things out there. There's tax evasion and tax avoidance. Evasion is criminal. You'll go to jail. That's not good. Avoidance, that's how the game's played. The tax code is set up for you to pay, to encourage you to pay the least amount possible, because that means that you're, doing good things, home ownership, adopting kids, doing all that kinds of stuff. Now, the tax penalties for, not paying your taxes or skipping out on your taxes, they're horrific because, well, it's just the way that they enforce the laws. It makes sense. If you're the FBI and you're trying to catch some guy with drug money Do you really want to get out there in some shootout with stacks of drugs and weapons and everything else? It's, people get shot doing that. What the IRS has done and what the politicians have done is they've upped the penalties on all the tax codes. So now all you have to do is you go to that, drug dealer, and he's got a stack of $1,000,000, and you ask where the tax return is. Where did you get this money from? Where was this income from? Show me the tax return. You can't produce the tax return. You still go to the prison, but nobody got involved and nobody got shot here. So that's why in most people's minds the penalties on tax evasion are so steep is because a lot of times they can't bust somebody doing something else, some criminal act, but they can bust them with tons of money that they can't account for, and giddy up, you're still in prison. That's what they want, and so they'll get to that end by using the tax code. Anyway, but again, don't overpay your taxes. Follow the rules and make sure your refund or your amount owed is as little as possible. Good luck.